Hello everyone, I'm Ankur Chaudhary from Hitbullseye.com, and in this video lecture I'll be continuing with the lecture series on financial systems. So first of all, let us try and understand what exactly is a mutual fund. So mutual fund is nothing more than a collection of stocks and bonds. So individual entities or people or companies or even the government, they would pool in their money with a particular company, a mutual fund company, and that company would invest this money in the stock market or in the bond market. Now, as far as the income is concerned, income is earned from dividends on stocks and interest on bonds. If the fund sells securities that have increased in price, then the fund also gives the benefit of capital gains. So there are three sources of income as far as mutual funds are concerned: stocks, interest on bonds, and capital gains as well, right? So mutual fund was initially introduced in the money market, but also now they have the freedom to operate in capital markets as well. So mutual funds are regulated by both RBI as well as SEBI. Next, we talk about the various types of mutual funds. So first, there are open-ended mutual funds. So these are the types of mutual funds in which the mutual fund is free to sell any number of securities. Next are the closed-ended mutual funds. Over here there is a limitation on the number of securities or stocks and bonds, etc., that this particular mutual fund can sell. However, this mutual fund, after it is bought by individuals or investors, it can be traded in the secondary market. Next are exchange traded funds. So these are type of funds in which the value is attached to different stock indices like Sensex, NSE, etc. Let's talk about the advantages of mutual funds. First, it allows for a diversification of portfolio. So the mutual funds give investors an option of investing in either stocks or bonds. Next is it offers professional investment management. So highly qualified investment managers are responsible for investing the funds or the investments of mutual funds, which the knowledge or expertise may be lacking in case of individual investors like us. Next, it offers liquidity as well. So once you invest in a mutual fund, you can trade it in the secondary market as well if you need in the money. So your money is not locked in a mutual fund, for example, like a FD or a fixed deposit. Next, it is a considerably safe option as far as investment is concerned, as there are considerable rules and regulations on mutual funds. Furthermore, due to the high volume of funds that are being handled by different mutual fund companies, the transaction costs involved are relatively lower. Next, we talk about a very important organization in the Indian financial system, that is Discount and Financing House of India. It was set up in 1988 by the Reserve Bank of India. Its major functions are: it maintains liquidity in the Indian banking system, and also it imparts liquidity to money market instruments as far as Indian financial market is concerned, right? So in the year 2004, RBI transferred its holdings of DFHI to the State Bank of India, who is now the majority stakeholder of DFHI. Furthermore, DFHI also functions as the largest primary dealer in the economy. So it is the largest purchaser of various money market instruments as far as India is concerned. So that brings us to the end of money markets in India. Now let us talk about capital markets. So it is a market for long-term debt and equity shares. As far as long-term is concerned, any financial instrument which has a maturity or relevance for more than 1 year, that is a long-term instrument. So primary market deals with trade of new issues of stocks and other securities. So within capital market, there are two types of markets. So first one we talked about is the primary market, and next we have the secondary market, which deals with exchange of existing or previously issued securities. So within primary market, if any company wants to raise new equity or sell its shares, it will go in for a IPO or initial public offering. So after these shares have been bought by individual investors, these investors can trade these shares in the secondary market. So as far as capital market is concerned, there is another important division, that is on the basis of the nature of security instrument that is being traded, right? So stock market deals mainly with trading in shares, and in the bond market, individual investors can trade in government related bonds. So now that we broadly understand what exactly is a capital market, let us take one by one a few very important capital market instruments. First one is stocks, or simply shares. So corporations, governments and companies, etc. issue securities on the stock market to collect funds. So these companies might sell a share of their ownership in order to raise more money from the equity market. They act as a platform for companies to raise money for their businesses and investors to invest in securities. So it is performing two functions, that is giving low cost funds to companies, and also it is providing a media for investors to invest their money. Stock markets again can exist in both real and virtual arenas. So with the advent of DMAT or dematerialized accounts, mostly stock trading is done in the virtual arena. Next instrument, that is bonds. So it acts as a platform for buying and selling of debt securities. So while stocks were for equity, bonds are for debt related securities. So the major bond market participants are governments, institutional investors, traders, as well as individual investors. Bonds are specific to individual issues with lack of liquidity. Bonds are not liquid because there is a fixed maturity periods associated with them. Various types of bonds are government bonds, municipal bonds, corporate bonds, etc. So these bodies issue various bonds in order to raise money from the public institution and other government bodies as well. Next is a long-term debt instrument that is issued by large corporations to raise funds from the market, that is the debentures. So they are nothing but long-term debt instruments which are not backed by collaterals. So these are issued by large and financially strong companies with excellent bond ratings. These ratings are of course given by credit rating agencies like CRISIL. So they are regarded as unsecured investment because there are no pledges, that is guarantees or liens available on particular assets. However, debentures have some similarities with bonds. However, the terms and conditions of securitization are different as compared to a bond. So the major difference between a bond and a debenture is, firstly, the debentures are issued by private organizations, and secondly, they are not backed by any collaterals, guarantees, liens, etc. And that is how the terms and conditions of bonds and debentures differ from each other. Next, we talk about another important instrument used by foreigners to invest in Indian stock market, that is the participatory notes. So these are offshore derivative instruments with Indian shares as underlying asset. So we will later understand what exactly are derivatives. They are not used within the country but rather used outside India for making investment in shares listed in the Indian stock market. They are issued by brokers and FIIs which are registered by SEBI or Securities and Exchange Board of India. Investing through P-notes is very simple and hence very popular amongst FIIs. It is very simple for foreigners to invest in P-notes because they do not require any sort of registration with SEBI. Hence they are very popular. But a major disadvantage is there is no way for us to know who owns the underlying securities or who is investing in Indian stock market. So it might be terrorists, drug mafias, etc. who invest in Indian stock market and make money out of it. So this is a major security concern as far as P-notes are concerned. Next, we talk about American Depository Receipts. So ADR is nothing but a stock that trades in the United States of America but represent a specified number of shares in a foreign corporation. So if there is a company like Infosys in India, its shares can be traded in USA using ADRs. It was introduced as a result of the difficulties associated with trading at different prices and currency values. It is bought and sold on American markets just like regular stocks, that is stocks that exist in USA and are issued or sponsored in the USA by a bank or a brokerage. So a US based bank or a brokerage firm will purchase these shares, and these shares are then sold in the US market and they are traded like shares of US based companies. Next is a very important concept within financial systems, that is derivatives. So derivatives is nothing but a security derived from a debt instrument, share, loan, whether secured or unsecured, risk instrument or contract for differences or any other form of security. The value of the derivative is entirely derived from the value of the underlying asset. So this is the most important aspect. So derivative as such is an instrument which derives its value from any other asset, which might be a share, a debt instrument like a bond, a commodity like gold, copper, or further agricultural commodities as well like cotton, wheat, rice, etc. So there are different types of derivatives which we'll talk about in subsequent slides. So the first type of derivative is the futures contract. So it is a legally binding agreement to buy or sell the underlying asset on a set future date. So as far as any asset is concerned, the price, the quantity, the quality, etc. these are standardized in a futures contract, and this contract is sold or purchased within the market much like any share. So on expiry of the date, the futures contract can be settled by either delivery of the underlying asset or cash. Next is a forward contract. It is very similar to futures contract but with a major difference. So forward contract is a contractual agreement between two parties to buy or sell an asset at a future date for a predetermined mutually agreed price. So as far as this definition is concerned, it is very similar to what a futures contract is. However, there is a distinct difference between futures and forward contract. In case of futures, the contract is standardized. So if say I purchase the contract, I can sell the contract to somebody else. However, when you talk about forward contract, it is an agreement between two parties in which they set the standards according to their own conditions. Hence, the conditions are not standardized. For example, the price, quality, the date, etc. Right? So as far as forward contract is concerned, the contract price is not transparent as it is not publicly disclosed because it is a contract between two parties themselves. Another difference is that forward contract cannot be traded in the secondary market. So last derivative that we talk about is the options contract. So the options contract gives the buyer or the holder of the contract the right to purchase or to sell the underlying asset at a predetermined price within or at the end of a specified period. So at the time of formation of the options contract, the price of the underlying asset is determined. Furthermore, the maturity period or the end period of the contract is also specified. So within this, the transaction has to take place and the option remains with the purchaser or the seller. The options contract can also be settled by delivery of the underlying asset or cash. So both the parties of the contract have the option of either delivering the underlying asset or settling the transaction through cash. So that brings me to the end of this particular video lecture. In this, we started off with completing a little portion of money market, and later on we understood what are the various components of capital market, as well as we understood the different major types of capital market instruments in the country. Thank you.